key takeaway from today's webinar is that there are rosier times ahead in the energy sector. It's going to take a while to get there, and I think in that context of supply versus demand, supply probably has to do a little more work to get things back a little bit more of an optimistic level.
The biggest concern for the U.S. energy sector is finding demand. We've done a really great job of getting supply to the market in a record amount of time, but now it's to balance that and find demand, even if it's local or domestic. I think that's the biggest issue right now facing U.S. energy.
I think when you look out at the models that places like the International Energy Agency and others have done, they're really counting on a pretty significant drop in supply by the end of 2016 coming out of North America. The problem with that is that supply has tended to surprise to the upside now for quite some time. So there's a lot riding on the drop in supply that is forecast as a result of that. This industry in the U.S. has been tremendously resilient, and they could throw another curveball at the market now by, in fact, not going down as much as possible, and at that point, the price of oil is going to continue to be pretty low numbers.
Global M&A is on track for a record level of activity for 2015, post-financial crisis. We can put this into context with the energy sector, which has seen a significant rebound after a fall in activity in 2013. 2014 saw very strong activity, and 2015 is continuing that momentum through.
If prices continue to slide, then the oil and gas companies within the region need to significantly change their approaches to the negative cash flow position. But this is not easy, especially given a lot of companies in the region are national oil companies.
Market indicators based on equity volatility are showing a weakening of credit risk across the board. But when you look at credit fundamentals, it becomes quite clear that the problem areas are those with credit scores CCC+ and below, which ranges about 10% of unrated entities at the best case within integrated oil and gas, and then ramping up to about 1 in 3 for coal and consumable fuels within the unrated entities.
Today on the webinar, I spoke about the Saudis in particular and what the market share war means for the upcoming OPEC meeting. I also talked about the global reach that the Saudis have as far as mixing it up with the non-OPEC and other OPEC producers in their grasping at new market share. Some of the competition is seen here in Europe. It's also seen a lot in Asia.
I talked about the oil market and specifically the oil supply glut that happens at the moment and dominates the market. The current lack of oil demand from Europe and China specifically, and the investment cutbacks from major European companies, with some projections for 2016.
I was discussing the parlous state of the European refining industry, where there's been a lot of consolidation over the last few years, and indeed there might well be more to come. With a large amount of imports of various fuels coming in from other regions, the European refining situation is not looking very good. I also discussed the Volkswagen scandal and its potential impact on the diesel markets in Europe. Diesel has long been touted as a green fuel. However, recent research and indeed the Volkswagen scandal itself means that this fuel might push itself out of the spotlight somewhat quickly.
I spoke about the credit implications of the EMEA energy sector given the current low-price oil environment. We spoke about how the aggregate level of credit risk in the Euro 350 for energy companies was at high levels, over 1%. We spoke about how, given this, even though risk levels are high for EMEA energy companies, in the broader picture of the global energy story, they're much better looking than the North America upstream heavy energy sector.